Good morning and welcome to the U.S. Chamber of Commerce. I'm Tom Quadman, Executive Vice President with the U.S. Chamber's Center for Capital Markets Competitiveness. I would now like to introduce our first guests who really don't need any introduction, Congressman Barr and Congressman Foster. Congressman Barr is the chair of the House Financial Services Subcommittee on Financial Institutions, and Congressman Foster is the ranking member. So, gentlemen, welcome to the virtual stage, and thank you again for joining us today. And I sort of get to change the tables a little bit, where I get to ask the questions and you have to answer, unlike as we normally do it. So, again, thank you.
Thanks for having us, Tom.
Sure.
Thank you.
So, just to give a little bit of a backdrop, right? Obviously, bank capital is very important for the safety and soundness of the banking system. And even though there are international frameworks regarding bank capital, actually here in the United States, we have always had tougher capital requirements than international counterparts, right? But, Basel III here with the endgame has been developed over the course of many, many, many years. And in fact, we had, as we'll talk about a little bit further, Chairman Powell and actually then Vice Chair Quarles were actually working on this years ago. And we'll get into that in a little bit. But as this was being developed last July, Congressman Barr and Congressman Foster, you both sent a letter to the Federal Reserve, and you asked for a holistic review of capital in the banking system before any proposal was made to implement Basel III. Following your letter, now Vice Chair of Supervision, Barr, talked about a holistic review. And he said that would inform the implementation of the Basel III endgame here in the United States. Congressman Barr, let me start with you and then turn it over to Congressman Foster. First off, did the Federal Reserve respond to your letter? And what's your feeling about how the process has gone in terms of moving forward with this proposal?
Well, Tom, it was disappointing. First of all, let me just say at the outset that the whole enterprise of Basel III was supposed to internationally harmonize bank capital rules, and that's not what's happening here with this proposal. This proposal would gold plate U.S. capital standards, dramatically increase U.S. capital standards in a way that would make U.S. firms less internationally competitive, and actually not harmonize those bank capital rules. The purpose of the Basel III endgame was to actually elevate the standards for European institutions to make them comparable to U.S. standards, but that's not what the proposal that was released in July 27th actually does, or what it proposes to do, which is, and it's a 1,089-page monstrosity that would dramatically increase the costs and decrease the availability of credit for a whole range of businesses across America, from homeowners, credit card users, municipal bond issuers, agricultural businesses, oil producers, auto dealers, builders, landlords, businesses, as you said, that use derivatives to hedge risk, privately held businesses, commission and fee-based financial services firms, all of those businesses, not to mention the homeowners and the credit card users, those and the local governments, all of those would be negatively impacted. It's estimated by the Fed itself that capital requirements would be increased 16%, but some private sector estimates are that it would increase capital by 20-30% perhaps. And just to give you a sense of the breadth and the scope and the comprehensive nature of this rewrite of federal banking regulations, the proposal would increase the regulatory costs of about $22 trillion of assets held by banks, which represents about 80% of all U.S. banking assets. That's how sweeping and substantial this change would be. And so that's why we're so disappointed in the process. We asked before the release of the proposal, Ranking Member Foster and I, for a quantitative analysis that would justify these dramatic and sweeping changes. And we didn't get a response until September, and then that response was very, very inadequate from Vice Chair for Supervision Barr. And now we think the process was so flawed because there was no quantitative analysis, because the regulators were not responsive to our requests, because there was no cost benefit analysis of any significance, and because the process was so opaque. The letter just basically said that they would take into account data submitted by the industry. That I think now the Federal Reserve General Counsel has gotten involved and recognizes that there are serious violations of the Administrative Procedures Act here. And so only recently now did you hear a statement from the Vice Chairman of Supervision that they would take in additional data from industry, and then have a second comment period to allow the private sector and businesses to comment on the data that would presumably inform the final rule. What they should have done, and they should scrap this and repropose it, but what they should have done is an advance notice of proposed rulemaking. That process would have been better and would have allowed people to, regulated entities to understand what the timeline is, be able to take in the data that they are actually using, and then comment on it. But as of right now, the opaque process looks to violate the Administrative Procedures Act in many ways, because we don't even know what data they're using or how they're using it.
Congressman Foster?
Yeah, well, thank you for having me. It's really important to, and I appreciate your focus on sort of Main Street businesses. I'm I guess best known around, outside of financial services as the science guy in Congress, but I'm also a businessman. When I started out life as a 19-year-old kid that started a manufacturing company that now manufactures most of the theater lighting equipment in the United States. And so we do hardware, software, sheet metal, and employ over 1,000 people, and have kept the jobs in the Midwest. So I'm very, very conscious of the impact of banking, because frankly, as our business was starting and growing, we were very dependent on banks. And so that's sort of where I come into this discussion from. I think the most important thing for a small business point of view is to have access to a variety of banks. Several times, probably many times as our business grew, we would go and look at the deal we were getting from our current bank, and then ask for options from other banks of all different sizes. We generally we ended up with the M&I Bank, which has now been absorbed twice, I guess, and is now part of a much larger bank. But it was very valuable to have multiple banks bidding for your business. And so one of the things that I really focus on when we talk about the holistic impact is the impact that it will have on the consolidation of banks, because that is a real threat. There are estimates that have been, there's a range of estimates for the impact of these changes. Probably the single most significant impact is that it will increase the cost of capital for the large banks, 40 or so large banks that will be impacted by this. And the estimates for the increase in their cost of capital are around 3 to 10 basis points. So 0.03% to 0.1%. And then there's the question of what fraction of that increase in the cost of capital will be passed on to customers. And so, I don't know, maybe half of it or something like that will be. But the point of this is that as a small business, if you go to 5 different banks and ask them for what rate are you going to quote me for my business loan, you're going to get a spread of not 0.03%. You're going to get a spread of 1 or maybe even 2% because of the knowledge that they have of your specific business. So it's really important to have lots of bids to consider, or if you're renegotiating your bank loan, to be able to threaten the bank that you're with getting a lower rate, because those are the percent level things that really are important to getting the best price for a loan for a small business. And so that is when after this proposal was noticed, I had several conversations with Chair Barr, the other Barr in this discussion here, and and so, we learned a lot about his thinking. For those of you who are worried about, what the thinking was and how transparent, I would urge you to have a look at his Nashville speech, and particularly the references of that. Because, when we talked about the response to our letter we got, that he pointed us to particularly the references in those. So how did he know that the impact on bank capital would be 0.03% for the largest banks? Well, there's a reference in there, and you can go and read the analysis there. But what I think the most important question that I think is likely to remain unanswered, no matter how we approach this, is how will the entire business ecosystem readjust to these bank capital requirements? There'll be all kinds of secondary unanticipated effects, and as a 15-year member of the Financial Services Committee, I have massive respect for unintended consequences. So we have to do our best at trying to figure out, how this will impact things like derivatives trading and everything else, for which the large banks are significant players. And so the information that is being collected, I think, was just the collection period just ended on January 16th, so very recently. And that will hopefully give the regulators a good idea of how banks anticipate adjusting their business model for this. And then, well, I hope will be reflected in the final proposal, if they see that big important sectors where only the big banks are the players, if there be significant readjustments, we should consider them now. And that's another thing, very far removed from Main Street lending, but very important to the economy as a whole.
Congressman Foster, you raise a couple of interesting points on Main Street lending, which I want to get back to in 1 second. But Congressman Barr, let me turn to you for one minute, and Congressman Foster, if you can also answer as well. Just going back for a second, where looking at the international proposal itself, right? This is an international framework, and as I referenced at the beginning, this has actually been going on for quite some time, right? And several years ago, when Vice Chair of Supervision Quarles was looking at this, both he and Chairman Powell at the time were looking at trying to implement Basel III, but to do so in a capital neutral way, right? So not raising capital rates, but ensuring that we were part of that framework. So obviously, there's a lot of water under the bridge, right? The economy's, gone through some tough times and all. But, do you think that there was an opportunity, or that there still is an opportunity, maybe to implement Basel III, but to do so in a capital neutral way?
Well, there is still an opportunity, but they need to scrap this current proposal, which is not capital neutral. It would impose massive new capital requirements, increase capital by at least 16%, probably more, as I said. So-called gold plating of American firms, and actually not harmonizing the jurisdictions, and imposing much more stringent standards on U.S. banks, and so that is not in keeping with the Basel III concept. One other quick point that I want to make about process: the Fed reached out to banks to collect data after they issued their proposal, and that data collection has just now been completed on the same day that the comment period has closed. And so this is one of the reasons why the process is so flawed, because the data collection was not completed in time for the public to assess and comment on the information. So that's why I think the General Counsel at the Federal Reserve realizes that there is a massive violation of the Administrative Procedures Act, and there's going to have to be some additional comment period allowed to assess the Fed's findings here, and there really does need to be a reproposal for that, and the public needs to be able to comment on whatever cost-benefit analysis is done here. But the substance of the proposal is very concerning because it is not capital neutral, as you pointed out. And I want to echo an observation made by my friend and colleague, Bill Foster here, because with his own personal experience about diversity within the banking sector, what we see in the proposal so far, and we mentioned this in our letters to Vice Chairman Barr, and we've mentioned this to the other governors on the Federal Reserve Board, is that it appears to de facto repeal the regulatory tailoring that the Congress in a bipartisan way was able to achieve in S2155. And that is a real problem, because the heterogeneity and the diversity of within our banking sector, the business model diversity, is what diffuses risk. It's what distributes risk across the system. It's what contributes to system-wide financial stability. And so the proposal, by de facto repealing regulatory tailoring and subjecting these Category 3 and Category 4 regional banks to the same stringent standards as GSIBs, the globally systemically important banks, and also by eliminating the use of internal risk models and transitioning regulators toward a more standardized framework, actually, I believe, undermines financial stability, because it's going to result in greater consolidation, less diversity within our banking system, much more concentrated banking system, kind of a barbell banking system. Those institutions that are not affected by the proposal, with less than 100 billion in assets, they're indirectly impacted, but they're not directly impacted. And then the large GSIBs would face huge new capital charges, but would result, because of the repeal of regulatory tailoring, probably a consolidation of banking. So we'd have a barbell banking system, a smattering of small banks, a smattering of big banks, but no regional banks. I think that actually undermines financial stability and reduces competition in a way that my colleague described, and that provides that not only the dynamism that produces economic growth, to have different types of banks and different serving different segments of the economy, but also that competition piece. We want to preserve and enhance competition. So the lack of capital neutrality will diminish economic growth, will diminish availability of credit, increase the cost of credit. But I think the worst part of it is it actually will serve to undermine financial stability by producing more risk concentration, less competition within the banking sector.
Congressman Foster.
Sure. Well, a couple of comments on sort of the international comparison. Prior to the financial crisis, the U.S. had much lower capital requirements, for example, than the Canadian banks. And in fact, the Canadian banks were sort of a laughing stock. But after the crisis, the Canadians harvested the benefits of having higher capital requirements. Actually, my personal bank is now owned by BMO, which is one of the results of that consolidation. And I believe that the Dodd-Frank reforms have succeeded because they were not capital neutral, that there was a real need to require banks of all sizes, but particularly the larger banks, to hold more capital. At the time, there were predictions from many people, many maybe advocacy groups, that the higher capital requirements as a result of Dodd-Frank and the regulatory implementation of it would put the U.S. banking system at a huge international disadvantage. Okay, well, let's look at the data there. The U.S. banks have increased their market share and become even more dominant internationally. And I think in no small part because people have confidence in the U.S. banking system, because the large U.S. banks are required to hold fortress balance sheets, as a famous CEO is fond of saying. And so this is important. Higher capital requirements cut both directions. They do have this effect of increasing the cost of capital by some number like 0.03% for the large banks. But it will. But it's important also. It was interesting during the mini crisis that we had last spring that the banks who suffered were the ones in the middle of the barbell. Okay, those were the ones that appear to have been underregulated and undercapitalized. And that's one of the ironies of this situation is that we're trying to, both Andy and I are trying to figure out how to maintain a reasonable distribution of bank sizes. And the challenge, frankly, for the intermediate sized banks is that they are doing much of what the giant banks are, but they don't have the same scale. And that makes it tough because as banks become more digitalized, then they have all of the same economics of purely digital businesses where there's a huge tendency towards consolidation and eventually monopoly. And so this is it's something that we're going to continue to struggle against, the natural tendency for digital banks to grow larger and smaller in number. And so this is, I don't know, when Andy, when you and I figure out how to preserve a healthy bank distribution in size, let me know.
Yeah, well, we've been talking a lot on the global level. I want to sort of now drill down in terms of how you're seeing this within your districts. And you've both been leaders throughout your time in Congress and ensuring that small businesses and startups have the financing that they need to start and grow. And interestingly enough, in my role here, also heading up our tech policy at the chamber, when I'm meeting with tech startups over the last several months, all I'm hearing from them is about capital formation, even though I'm there to talk about, let's say, AI or quantum computing. But, even though we filed a comment letter yesterday on Basel III, we've been, very engaged on these issues for a long time. And in fact, last November, we sent a letter with 17 other associations to the banking regulators where we started to walk through what some of the business impacts are, notably how having to hold more capital against private companies is going to disincentivize lending to them. Operational risk issues are going to make it more, difficult for small businesses to get credit cards, right? And punitive treatment of unused lines of credit obviously hurt as well. Congressman Foster, as a business person, you were eloquently talking before about, what those impacts are on businesses. If Basel III, as it was proposed, were to be implemented, how would you see it impacting small businesses and mid-sized businesses in your district?
Yeah, well, there's sort of two classes of them. The venture startups are financed by venture capital. In general, sometimes you can find a bank with enough courage to make significant loans to venture capital. But, in general, they prefer businesses they can understand. And so trying to understand, for example, whether the patents that this company may or may not have are really going to end up being solid. This sort of question is a very high risk and high cost analysis to take place. And I think it is correct for that mostly to take place outside the banking system, just because it's such a high risk loan profile to loan to a small startup or even to invest in a small startup. And so the venture capital business goes through boom and bust cycles. And right now, with the exception of AI, unless you're an AI startup, it's not a great time to be a venture capitalist. So if you're just trying to do, yesterday's fad, you're trying to be a battery startup, something like that, it's not it's not as easy as it was a year or two ago. I think in general, the business climate is really good. My first measure of business climate in my district, I just drive by the strip malls and count the number of empty stores. It's down near zero now. We're seeing a record number of business startups, which is pretty impressive. A lot of people got off the couch after COVID and decided, okay, I'm going to finally start my own business, and a lot of those are succeeding and thriving. So it's really good to see, and a lot of those are dependent on bank loans to expand their business. So our system is working pretty decently right now, at least in my district. Chicago gets beaten up a lot. I represent metropolitan Chicago. But metropolitan Chicago was the number one area for businesses to relocate into. All right, and that's that's something that I know I'm personally very proud of, and we have a lot of tech businesses moving into Chicago as well. So I think that the combination of bank loans and venture loans are doing a pretty decent job, and really responsible for why we're seeing kind of a boom in startup businesses, at least in my district.
Yeah, in other words, if it isn't broken, don't fix it. Congressman Barr, what are you seeing with small and mid-sized businesses in your district? How do you think it'll impact it?
Yeah, I represent Central Kentucky, and the type of small business. We have small manufacturers, we have builders, we have retail. There's a lot of horse farms, horse businesses, bourbon distilleries in the district, a lot of auto manufacturing supply chain businesses, because I represent Toyota, the largest Toyota plant in actually the world, in Georgetown, Kentucky. And so that supply chain is a big part of our economy, those small businesses. And the truth is that inflation still continues to be a top concern, and supply chain issues continues to be a major concern. And it's not that the rate of inflation hasn't come down. The Fed has, I think, with their tightening project, succeeded somewhat in bringing down the rate of inflation. The problem is that the toothpaste is out of the tube. The damage has already been done. Reducing the rate of inflation doesn't always reduce prices. And so the cost of living has gone up, and real wages, inflation-adjusted wages, haven't kept up. So households are suffering. With mortgage rates being where they are, that has impacted the housing sector significantly. And so everything still costs more, even though the rate of inflation has come down, whether it's groceries, whether it's gas in the tank, whether it's rent or mortgages, everything costs more, even as the rate of inflation comes down. And here's what I don't understand about the Fed's Basel III endgame proposal. It works at complete cross purposes of their tightening project. The idea that they want to whip inflation by increasing interest rates and reducing the balance sheet and quantitative tightening, while at the same time they're rewriting the federal banking laws to constrain supply. We need more supply of credit and capital. This is the worst possible time that the Fed could be proposing these regulations, which would constrain supply at a time we need more supply of capital and credit in the economy for these small businesses. It is a supply-demand issue. We had excess demand that was produced by a lot of overspending, and then we constrained supply of labor by paying people to not work, constrain the supply of energy, and then now we're proposing to constrain the supply of capital and credit to small businesses. That is not a recipe for getting that inflation target down to 2% and achieving the price stability that the economy needs to really thrive. And that's the real concern that a lot of small and medium-sized businesses have right now. And I'll tell you that I'm really concerned about the commercial real estate sector, because you've got $1.5 trillion of commercial real estate coming due maturities in the next couple years. And so there needs to be that liquidity available to refinance. It's going to be hard enough to refinance at higher rates. Banks need to be able to deploy capital, provide that liquidity to refinance. And by the way, not just commercial real estate, but a lot of corporate credit too. And that's why non-public companies that, private credit, I think that's an area that we're looking at from a financial stability standpoint. There's going to have to be a lot of refinancings at higher rates. We need the banking sector to be resilient and be able to deploy that capital. These bank capital requirements will make American banks much less competitive, especially those regional banks that serve that middle market. We need those regional banks to be able to deploy that capital. And Tom, if I can make one other point.
Sure.
If the idea here was to respond to the bank instability that we saw back in March, this is a regulatory non sequitur. The issues with Silicon Valley Bank, First Republic, some of these other regional banks that we saw fail, that was really a product of interest rate mismanagement and depositor concentration risk. This was not a capital inadequacy issue. And so the proposal here, it looks like that the Fed and the regulators are using the bank instability, which was a supervisory failure, which was a interest rate mismanagement failure, as a pretext to push an agenda to dramatically increase capital requirements on U.S. banks that are already well capitalized.
Yeah, it's sort of like, just giving more and more cold medication for a broken leg isn't necessarily going to work, right? Well, gentlemen, thank you so much for, providing these insights, both in terms of your public and private experience and how do you see this impacting your districts. And we could go on for much longer, but appreciate your leadership on these issues and on business lending. And we look forward to talking with you and working with you on these issues further. So thank you so much for joining us today. And I'm going to kick it over to Foxhole Parker to continue the program.
Thanks, Tom.
Thank you.